So is now the time to be buying quantum computing stocks? Or are we just watching a bubble that's about to pop? I've been hearing this question a lot lately, so I figured let's cut through all the hype. I've personally dug into the financials of every single major publicly traded quantum company to figure out one simple thing: who's actually built to last and who's in real danger of getting kicked off the stock exchange.
And yeah, that's really the question we're going to answer today. Which of these companies is actually going to survive? Because after digging into the numbers, the answer is, well, it's pretty stark. The quantum industry is at this massive fork in the road. It has become a true case of survival of the richest.
You see, this so-called quantum winter that really put a chill on the industry through 2024 is finally starting to thaw out. But not everyone made it out in one piece. The market has totally fractured, and it's revealing three very different kinds of companies. You've got the cash-rich winners, you've got the survivors who are basically printing stock just to stay in the game, and then you've got the strugglers who are genuinely at risk of disappearing.
So here's the game plan for how we're going to break this all down. First, we'll talk about the two simple metrics that matter most. Then, we'll look at the untouchables, IonQ and QBT. After that, we'll get into the survivors, D-Wave and Rigetti. Then we'll examine Arkit, a company walking a very, very thin tightrope. And finally, we'll pull it all together in one big financial scorecard. All right, let's get into it.
Look, to cut through all the noise, all the complex jargon, you really only need to focus on two key numbers in their financial reports. Think of these two metrics as our survival toolkit for grading these companies.
First, and honestly, this is the big one, cash. Just think of a company's cash pile as its fortress wall. In a field this expensive, where real profits are still years and years away, having a massive pile of cash is the single most critical factor for survival. It's the fuel they need just to keep the lights on and keep the research going.
But a huge pile of cash isn't the whole story, right? The second metric is revenue growth. And why is that so important? Because it's the ultimate proof that the company isn't just some science project. It shows they actually have a product or a service that real customers are willing to pay for. It's the sign of a real business.
All right, with those two tools in our back pocket, let's start at the very top. We're talking about the companies in the absolute strongest position. These are the cash kings, the ones who are way past just surviving and are now thinking about total market domination.
And first up is IonQ. The conclusion here is super simple. Its delisting risk is basically zero. Now, what's so fascinating here is the contrast. On one hand, you see this incredible revenue growth, a 222% jump, which is amazing. But on the other, you see a net loss of over $1 billion. Now, don't panic. That $1 billion loss isn't cash flying out the door. It's a non-cash accounting thing tied to warrants, which are kind of like stock options. They get more expensive on paper as the stock price goes up. If you look at their actual cash burn, what they call adjusted EBITDA, it was a much more reasonable $49 million.
And this number is why that cash burn doesn't matter one bit. After a recent offering, IonQ is sitting on a mind-boggling $3.5 billion in cash. With that kind of war chest, they have a runway you can measure in decades, not years. They are not worried about getting delisted. They're probably sitting around deciding which competitor they want to buy next.
Now, next in the untouchable category is QBT, and this one is a real surprise. It's a niche company focused on chip foundries, and its revenue is still tiny, just $384,000 last quarter. But, and this is a big but, through some very clever financial moves, they have secured a massive $1.25 billion funding line. So even with tiny sales numbers today, their financial fortress is totally secure. Delisting risk, very, very low. The big question for them now is how fast they can turn that billion-dollar pile into a real money-making business.
Okay, let's move down a tier to our next category, the survivors. These are the companies that have managed to secure their future. But wow, it came at a huge cost, especially for the early investors. They've really paid a price to stay in the game.
And D-Wave is the perfect example of this trade-off. In early 2025, they were staring down a cash crisis with only $29 million left. But they pulled off a huge turnaround, boosting their cash to over $800 million. The catch? They did it by just selling tons of new shares on the market. They nearly doubled their share count, which means existing shareholders got heavily diluted. So yeah, the company is safe now with an 8 to 10-year runway, but the value of each person's individual slice of the pie got watered down. Then we've got Rigetti. Now these guys are known for having great technology, but they are definitely an innovator on a budget compared to the giants. They have about $600 million in liquidity, but their revenue actually went down 18% last quarter, mostly because of gaps in government contracts. With a cash burn of about $15 to $20 million a quarter, they've got a solid 3 to 4 years of runway. So the risk isn't immediate delisting, but if IonQ and the others start a price war, you can bet Rigetti is going to be the first one to feel that pressure.
And that brings us to our final category, a company that is truly walking the financial tightrope,
For Arcit, survival is not a guarantee. They are living life right on the edge. This is the number that just says it all. $37 million. That's Arcit's total cash on hand. Now compare that to the $3.5 billion at IonQ. The difference is it's staggering, and it puts them in an unbelievably precarious spot.
And this slide, this shows the classic sequence of a company in deep financial trouble. First, the stock price fell below that critical $1 minimum on NASDAQ. That triggered an official delisting warning. To fix the stock price, they did a 25-for-1 reverse stock split. But, and this is the most important part, that doesn't solve the real problem. The company is still running out of money.
Arcit is burning through about $2.5 million every single month. That gives them a runway of maybe 12 to 15 months before the cash is just gone. They are deep in the corporate death valley, that terrifying period where a company might run out of money before its product really takes off. They urgently, desperately need to either start generating some serious revenue or find a new source of funding, and fast.
Okay, so we've broken down each company one by one. Now it's time to put them all side by side and see exactly how they stack up. This is the final financial scorecard.
And there it is, all in one place. You can see that three-tiered split we talked about, clear as day. The industry is not one big group anymore. It's a hierarchy. At the top, you've got IonQ and Qubit, who've built these financial fortresses. In the middle, D-Wave and Rigetti have bought themselves time, but they are vulnerable to pressure from the top. And down at the bottom, Arcit is in a serious fight for its life. This isn't just a scorecard. It's basically a preview of how this industry is going to consolidate in the future.
So when you look at all the numbers, what does it really mean for an investor? Well, to put it simply, if you're the kind of person who wants to avoid sleepless nights, worrying about your investment completely disappearing, the financials really point to one very clear choice at the top of that list.
So what are the big takeaways here? First, the quantum sector is completely split into the haves and the have-nots. For investors, that means the risk is not spread evenly anymore. Second, while the survivors have bought themselves time, they're facing a brand new threat, just sheer competition from the cash-rich leaders. And finally, in this incredibly expensive race, two metrics matter more than anything else: cash in the bank and real, growing revenue.
Which really leaves us with one final and, I think, crucial question. For the companies that have solved the money problem, the fight for survival is pretty much over. So now, the real race begins. The race to build a profitable business. Who do you think is going to get there first?